Into some greatness today. I've got a Top Step account. Honestly, I've been so focused on everything in my life lately that I don't do a lot of trading. I trade a little bit in the morning. Um, but I have a Top Step account that I play with every now and then. For the most part, I'm building lessons and working on TradingView and trying to break accounts for the funding company and just gone a different direction for a little bit. I'm enjoying teaching more than trading lately. It seems to be. Happens. It's the cobbler's kid has no shoes kind of thing. Kind of funny. Good morning, everybody. Cav, Ron, Steve. Good to have you guys here today. Hope everybody's doing well. Better Dad, great to see you back in here. Lou Dog, hope you're doing all right. Let's check news. Forexfactory.com/calendar. Just looking to see if there's anything going on. Today's Tuesday, March 4th. There is the tentative RCM tip economic optimism. Don't have any idea what that means, but it's low impact. Good morning, Bob. At 8 p.m. tonight, if you find yourself trading, Paul, you're one of the people that like to trade at night. President Trump is speaking. Something could go sideways. Hopefully it's my crypto account going up. But every day I check news and I just want to make sure I'm not trading into a release, typically the high impact, because it can move the market and it can change it and it can make it spike and bump and go too fast to be tradable. So not trading what they're saying, rather trading the potential for the reaction, or not trading, actually avoiding trading the potential for the reaction. Everything that I talk about in this room every day comes from the Nexgen site. There really isn't anything that we hold back from you. There is no, let's give them a little bit and charge them for more. I will never be able to give you everything that can be done with this software because you're going to find your way to use it. Instead, what I'm going to do is I'm going to help you learn how to read the software. That's my job in the room, is to help you guys learn how to read the software, learn how to recognize patterns, and then make good decisions based on the advantages that you see. And I do this with a high probability trade. And this is defined as when each indicator on every chart agrees with the rules for the trade. Triggers are their strongest. No termination conditions exist. There's no trouble spots between your entry and your target. And my first hour of class every day, it's important that you understand it is focused on the absolutely positively highest probability best way I could ever teach a brand new user to use this software. From that high probability trade, you're going to begin to find your trades. You're going to begin to see more. You're going to manage differently. You're going to look for different entries. You're going to find different conditions. And it's all a byproduct of your ability to read your indicators. And that is what the high probability trend trade does for you, is it teaches you, to read your indicators, to be able to look at your charts and identify a couple advantages, and then you're going to turn those advantages into trades. 90% of your day will be spent waiting for advantages to come into play, for a pattern to present itself that has been proven to win more than it loses. 10% of your day will actually be trading, getting in and out of the market, management, stuff like that. And once you can read your charts, once you can look at your indicators and identify things that are going right and things that are going wrong, you're going to understand, just from that little basic understanding, where the market is likely to continue, where it's likely to go, and where it's likely to stop. And those are going to work their way probably into everything that you do as a day trader. So first, I'm a chart reader. And because I'm a chart reader, I can identify advantages to become a day trader. This high probability trend trade that we're going to talk about this morning, this is a trade that typically wins 70 to 80% of the time when you follow the rules. This is a trade that creates confidence through that memory of success. This is a trade that teaches you to read your indicators. And I know there's some of you that are relatively new that are like, man, he said this yesterday. Hasn't he said this every day? Guys, I have. I say the same thing every day. The only time my classroom changes is when you guys ask questions. Each rule for the high probability trend trade provides an advantage when true. My hope for you, like if someone said, Mark, what do you want people to get out of this classroom? My hope would be that you look at your charts and you identify and say out loud whether or not you have these three advantages as you look for the high probability trend trade. So your first rule provides the advantage of momentum, meaning that you have a market where the odds are favorable for it to continue in the direction of the trend. Rule number 2 says termination's false. This is going to give you room to profit targets. We're just going to call it a clear path. And a clear path means that there's no key areas in your way that could stop the market, no termination conditions. And then finally, rule number 3 is specific to trend trades. And it's just designed to get you into the market to identify where the market is most likely to continue with the underlying trend. So when you put these 3 advantages together, the result is the entry for the highest probability trend trade that we teach. Every day in this room, I like to remind you guys that momentum and clear path, these first 2 rules, once you can identify them, once you're confident identifying them, once you understand what they mean to you in terms of advantages, this is your core and your foundation. And you're going to see a lot of trades presented in this room that really rely on momentum and path. Being able to identify an advantage or being able to identify that an advantage is not present either puts you into the market or maybe it puts you into that 90% where you hold off a little bit. These 3 rules happen on only 2 charts. I try to keep this room as simple as I know how, as basic, as focused on only what you need, not what's capable. Your large chart leads the way. Your large chart is the first chart that you're going to look at. And honestly, you can use the first bar that prints on the large chart to be able to identify direction, momentum, and areas. Your first 2 rules are met on the large chart. Rules 1 and 2 can be identified as either true or false on the first bar on the large chart. It's a very slow moving chart. It's a broad stroke of a brush and it's difficult to see. Once the rules are met there, once you have momentum, once the path is clear, you'll turn your attention to a small chart. And this small chart is nothing more than a refinement chart. It gives you an x-ray of what's going on inside of that 1 bar. So inside of 1 bar on the large chart, you're going to see typically a full push and a bounce and a continuation. Very often 15 to 30 bars on a smaller, faster chart, showing you both up and down, when the large chart it continues to stay down. So we use this refinement process to pinpoint the best of the best entries for the highest probability trend trade. We use this refinement process to reduce risk, to increase profit potential. And rule number 3 is nothing more than an entry rule, and that entry rule is on the small chart. We're using these 2 charts because they are very much a reflection of who you are trading with or who you are trading against. Your large chart, I'd like you to think of them as the large crowd. The large crowd dictates what the market's going to do. The large chart creates, the large crowd creates trends and produces momentum. And the large crowd reacts at key areas. So trading with them tends to be your highest chance of success. Trading against them is what we like to call the recipe for financial suicide. But your small chart is a small crowd, and they throw themselves on the proverbial sword every now and then. And they fight. And when these guys say up, they say down, and vice versa. And their fights are those little movements that you can't see on the large chart. You can only see inside on that refinement chart. And these little pushes against everything the large crowd wants, they typically fail 70 to 80% of the time, which means that when you use rule number 3 to define your entry for the highest probability trend trade, you are actually pinpointing right where the small crowd is most likely to fail. And if they're failing 70 to 80% of the time, well, you have the potential to win up to 70 to 80% of the time. Is it Fat Tuesday? I still don't understand that. Sounds like shaming to me, Fat Tuesday. I don't understand the idea behind it. Tomorrow's Ash Wednesday. Does it have something to do with the holiday there? Okay. So here's how it's going to go for the next 60 minutes or so, ladies and gentlemen. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. I'm a big fan of language. You're going to see that in the way that I teach. And when you say, okay to trade, not for me, Gary. Steak Friday, always. I'm going to learn the trigger line and the Fibonacci rules for when it's okay to trade. I'm going to commit to having my rules met. I'm going to commit to having 3 advantages before I enter the market. And if those advantages aren't present, I'm going to choose to not enter the market because I don't have the advantages that I need. Guys, you can simulate every day. Right on, Gary. You can simulate, you can practice, you can mess up rules, you can make mistakes. Guys, that's okay. That's part of the education process. Oh, giving up, quitting drinking. Yeah, I went right over my head. I am teaching a class, so, you know, not totally focused on the comments just yet. I totally miss it, Gino. The first step in getting where you want to be is posting in the room. Guys, post in the room. Every time you take a trade, post in the room. Every time you look at your charts and you have no freaking idea what's going on, post in the room. Ask for help. Ask questions. Every time you post in the room, well, you get a free private session with me. But I need you to follow a recipe when you post in the room, guys. I need you to tell me what it is you're doing. Tell me why you're doing it. So this is a great example of how to annotate your charts, guys. Talk about strong triggers. Talk about whether or not the path is clear. Talk about what it means to you. Show me your entries. Talk about why you entered. Talk about your exits, where your targets were. If you do all this, we're going to hit a lot of different things. First, I'm going to see how you're reading your indicators. Is your indicator reading accurate? Are you doing it correctly? Are you convincing yourself you had to have advantages when none are present? Or, you know, are you missing out on some of the advantages that you should be taking advantage of? When you write the why you traded, what you're doing is you're creating a recipe to make the good trades repeatable. And even more importantly, making the wrong trades avoidable. So, Andy, I'm not beating you up on this one. Please, I know Andy. Andy knows I love him. But Andy said, that wasn't the one. Andy posted a picture this morning, and he said, sell. Well, okay. Why? Target. Why? Why are you fighting everything? What's the recipe? What's going on? How do you make this victory repeatable? And that's why we're doing it, guys. I don't need you to annotate your charts for me to be able to read your indicators. I need you to annotate your charts so I know what was going on in your head so that we can set you up for long-term success as opposed to that short-term success, getting lucky, fighting everything, making money when it's less likely that the trade is going to win. So do me a favor, follow that recipe every time you post in the room, and I'll give you the best feedback I know how to give you. We're going to simplify. I'm going to hand you a plan that only has 2 trades on it. The first trade is the highest probability trend trade, the best of the best way that you could possibly take it. The second trade, is a medium probability trade, but it's based on being able to read your indicators from the high probability trend trade. I'm going to give you both of those Your job is to learn the looks, to know what it looks like to have your rules met, to know what it looks like to enter the trade, to have the patterns. And that's where the second piece of becoming confident ASAP comes from. Guys, use the spreadsheet. I give this to you every day. Nexgen gave it to you in your Nexgen Study Picks folder when you downloaded the software. The spreadsheet, it's just a visual. It creates recognition through repetition, guys. The first page is where you're going to follow and you're going to practice the rules individually. You're going to take pictures of them. You're going to study them. The second page is about 400 pictures. The client's doing great things. The third page is where you're going to put your pictures to build your plan. And the final page is just a place to track your trades. Every time you do something, put a picture, talk about your advantages, but most importantly, discuss the feedback that you received in class. Put a little snippet. And what happens is you're going to use that last page if you really want to get to where you want to be, the fastest, the fewest mistakes repeating, is, guys, every morning go study what you did yesterday. Every morning ask yourself what worked and what didn't work. Commit to the things that worked. Commit to avoiding the things that didn't. You'll recognize that the right trades feel easy because you believe in the advantages. The wrong trades will get you nervous. You'll be very uneasy. You will move stops and targets and panic a little bit. But if you do this brief historical study each morning, it really does prepare you for the day. And what happens is the feedback you receive will begin to identify not only the patterns in the market that are bringing you success, but really, and most importantly, the patterns in you that seem to be taking that success from you, whether it is trading in determination conditions or fighting trends. So, guys, go through that process. Post in the room everything. The first hour is designed for rules. The second hour is where I start going through your pictures in the order they were presented, and you will get feedback on everything that you do. By the end of this first hour, within the next 70 minutes, guys, you will have every tool that you need to be successful with this software. The only thing that I'm not going to place in your lap is the work ethic. It's the getting it done, taking the pictures, participating in class, all that good stuff. So let's get going. What are we looking at? Every time I open up my charts, I'm going to see triggers. Triggers, there's two types. There are small triggers and there are large triggers. Small triggers are solid lines. They're a fast-moving average. Large triggers are dashed lines. They're a slow-moving average. The only thing you need to know about trigger lines is that these are small and these are large. You're going to use them everywhere. You're going to use them to define the momentum for rule number 1. You're going to use them to define termination conditions in rule number 2. And you're going to use them to create precise entries following the rules. Rule number 3, designed to get into the market where the market is most likely to continue. And the great thing is, all you need to know is that these are small and these are large. Each chart will have areas. We're just naming them. There are divergence highs and divergence lows. These will print from a pivot if momentum doesn't follow. If the buyers are in control, the sellers say no and steal their momentum, you'll see a pink line and a negative number. If the sellers are in control and the buyers say nope, no more, we're stealing your momentum, you'll see a cyan line. So I want you to associate divergence with loss of momentum. You're going to see Fibonacci resistance, Fibonacci support, red lines, blue lines, yellow 1-to-1s, and then a mid-band. Mid-band's just going to squiggle through the middle. It's nothing more than a moving average. If price is above it, it'll be green. It may act as support. If price is below it, it'll be magenta. It can behave as resistance. You'll find that there is a lot of color coding designed to help, and you'll see it as we go through the rules. So I'm going to talk about 3 rules. I'm going to break them down individually. I'm going to show you exactly what they look like, and I'm going to use some pretty strong language to describe it. Not strong as in offensive, but strong as in impactful. And we're going to start on the large chart. And rule number 1 says that you must have strong trigger lines, because strong trigger lines give us the advantage of momentum. So We're going to go to the large chart, and before you ever look for strength, you're going to define direction. If the background is green, that market is going up. You're looking for rules to be met for high probability trend trades long. Defining direction doesn't use the triggers or the areas. Green is up, red is down. Your path of least resistance is finding trades to go with the direction of the market. The only way you can have strong triggers on your large chart, or really on your small chart, is if all of the colors match. So if my background is green, both my small triggers and my large triggers must be green as well. If colors don't match, you don't have strength. And if you don't have strength, rule number 1 isn't met. Strong triggers in an uptrend means that the smalls are above the large triggers and the large triggers are widening. They're opening up. And then the gap that's created between the small and large, when those small triggers break above and away from the large triggers, this is when the odds are favorable for the market to continue up. And when the small triggers break below and away from the large triggers, that separation means strength. The odds are favorable for the market to continue down. And guys, this look of momentum is universal. It doesn't matter what chart you're on, whether it's a large chart or a small chart, a range chart, a month chart, a stock chart, a future, it doesn't matter. Separation is strength. And when it looks like scissors are open, it's good. And when those small triggers return, they get inside of the large triggers, guys, this is weakness. This is what we call weak triggers. Weak triggers can create big ugly retracements. Weak triggers are when key Fibonacci areas are more likely to hold. So we're going to go to crude oil live. And guys, I want you to know if you're with me here. All the colors match. Separation between the triggers. Guys, we're going to call this odds favorable momentum, OFM. And when I have odds favorable momentum, that market is likely to push in the direction of the trend. When the separation is between the small and the large, everything is up. Once again, odds favorable momentum. Guys, this is rule number 1 met. That's your look. And then now we've got smalls inside of the large. The separation is gone. This is weakness. And let's just annotate this one, ACH. Anything can happen. So brand new users, let it be decisive in the beginning. Let it either be momentum or weakness. And don't trouble yourself with trying to figure out the in-betweens, because strong triggers push a market, and strong triggers can break key areas. Strong triggers up, or when we're looking to buy Fibonacci support on a smaller, faster chart, it looks like a tail on the large chart, nothing changes. Guys, this tail is the retracement on the small chart, the fight from the small crowd. You're going to be able to pinpoint where these tails are most likely to form with the rules met. You're going to be able to pinpoint where these tails are most likely to form. And you can use these tails historically to go back and study these patterns. So strong triggers leads the way. Can you guys give me a why if you're with me? There's really only one look, separation between small and large. Everybody's good? Better data, like it. Guys, once you have the momentum, once the market's pushing, once it's hard to stop on that large chart, we got to make sure there's not a brick wall in the way. No termination conditions, no areas that may stop the market, guys, because we want that clear path. We want room to our profit targets. Here it is from the manual. What's a termination condition? Well, it's a Fibonacci-based indicator that has the potential to stop the market. Ladies and gentlemen, it's a horizontal line on your large chart. That's the easiest way to remember it. If you see any of these, divergence high, divergence low, Fibonacci resistance, Fibonacci support, yellow 1-to-1s, this is where the large crowd is most likely to make decisions. This is where the market has the largest potential to reverse. This is the areas that can create big untradeable bounces. These areas also break sometimes. And guys, we're just going to use a comparison of the area, support, resistance, 1-to-1s, divergence highs and lows. And we're going to use those trigger lines again. But now the trigger lines are going to let us know if they're a termination condition, if they have the potential to break, or if they've been broken and now your path is clear. So in order to identify a termination condition, first you're going to let the large chart get there. You're going to let the large crowd show up to that decision-making point. And if price reaches resistance, your dynamic Renko bars, those price bars, come up and get to Fibonacci resistance, get to a divergence high, get to yellow 1-to-1s. The only thing you have to do is ask yourself, where are my triggers? If the triggers remain below, it's a termination condition. It may reverse the market. It may create an untradeable bounce. It may break. It may stall out and just dance there for a while. You'll never know what the reaction's going to be. You like to think you do, but you won't. You'll never know what the reaction's going to be. So if price reaches the area and the trigger lines remain below, no trades into the area. It's really that simple. Sellers are in control. Market's cranking down. They reach Fibonacci support. They reach a divergence low. They reach yellow 1-to-1s. You guys all say out loud, scare the dog, where are my triggers? They're above support. Support may stop the market. It may create an untradeable bounce. It might dance there at the fib for a little bit, or it may reverse it completely. I'll never know what it's going to be, so I choose not to trade into the area because more often than not, it will cost me money if I do. That's how rules come to be, guys. It wasn't one day of going, oh, look, it bounced off a line. It was probably tens of thousands of pictures at this point, where when price reached an area and the triggers didn't break, it created a big untradeable bounce. And let's go back to crude oil live because they're putting on a clinic. Resistance held with all the triggers below. Resistance did it again. It did it again. It did it again. Divergence low held. Support held. Resistance created a giant bounce. Guys, all you have to do is learn this very basic recipe and it's going to keep you out of a lot of trouble. If that no triggers through termination condition reverses the market, if it makes those large triggers go from green to red or red to green, then we're going to call that a strong top or bottom. And a strong top or bottom in regards to the high probability trend trade is not a rule, but it does set you up for the highest probability trend trades you can take. So if I get my rules met after a strong top or a strong bottom, that's the best of the best. And remember, that's what we're talking about in this first hour, optimizing your chances of success. A strong top or bottom is also rule number one for a lot of the trades that you're going to take beyond this high probability trend trade. It is rule number one for the 50-50 trade, for that medium probability trade that's going to be on your plan. It is rule number one for high volume area trades when you incorporate a market flow chart. It's rule number one for the momentum trade that you're going to see that's available to you once you learn how to read your indicators. So keep it very simple. Either the area is a termination condition or it's broken. And once you can tell the difference between the two, it sets you up for the next trade. And the next trade is based on the potential to break. So let's go through the life cycle of a fib breaking. First, price reaches resistance. All the triggers are still below, smalls and large. And this is a termination condition. This is an area where I don't know what the reaction is, what it will be. So I'm going to sit on my hands and wait, and I'll see what the reaction is. And guys, it means that I have to just be patient. It means that I have to do nothing for a minute. If my small triggers, both lines of the small triggers smash through the area, embrace that word smash. Let it get 3 or 4 points above. But the large triggers are dragging their feet, lagging behind. They haven't made it through the area yet. Guys, this is what we call a 50-50 look. And a 50-50 look means that that fib has the potential to break. With all that momentum, the potential is there for that fib to break, but it's not quite broken yet, because the only way an area is ever considered broken is if both the small and the large triggers, both lines of each, get above resistance. Now resistance behaves as support. Now resistance is broken. Now my path is clear until I reach the next area. Bob put an awesome picture in there, and he said, hey, Mark, I noticed that the color of the fib changed. Guys, I'm going to tell you right now, the color of the fib has nothing to do with whether or not it's broken. There's some algorithm stuff, there's some techie programming stuff in there where there's a certain set of conditions that are met, and that's when the fibs start to change color. And I'm going to tell you right now, the triggers tell the story. Price reaches the area, and we're done with price. Your triggers will let you know whether it's a termination, has potential, or if it's actually broken. And you'll notice that that fib turned blue before the large triggers got above. And if you scroll back on a couple charts, you'll notice that that fib does change color sometimes, even though the area didn't break. And then there's a great example of it. The smalls barely get through resistance, and they turn blue, but look where the large triggers are. And those 1-to-1s stop the market completely, create the reversal, and down it goes. Smalls and large do not get through support, guys. That's where that bottom was put in. And now the smalls and the large are above resistance. Resistance is done. It's broken. The path is clear, but the fib is still red. So don't get caught up on the colors. Focus on your trigger lines. Is everybody good with that? Termination, potential, broken. And then the path remains clear until you reach the next area. Guys, rule number 2 is the most broken rule among new users because rule number 2 is going to force you to be patient. There's another termination condition on that list. 3 divergences in the same price range may terminate a trend. It can be 3 divergences on a large chart. It can be 3 divergences on a small chart. You will see it on a small chart first. So if you see 3 divergences in the same price range, and we define the same price range the same way we do areas, if the small and large don't get below this divergence isn't broken. So 3 in the same price range may terminate the trend. And if you see the yellow box here, I've got 3 divergences in the same price range when the large chart isn't showing me anything. The large chart still looks like it's going down with the potential to break. So your small chart can show you change that you can't see on that big, slow, large chart. And this is kind of a heads up. And guys, 3 divergences in the same price range is the only time on a small chart where I will refuse to enter a high probability trend trade if the large chart rules are met. And then there's one more, and this is called the gap theory. The large chart midband is a termination condition only if the large triggers are a full bar away. So, and this sets us up for entries. If price accelerates away from large triggers, it almost always returns at some point. If price accelerates away from large triggers and hits a midband, and those large triggers, there's room for an entire reversal bar to get back to it, guys, the midband is behaving as a termination condition. The same is true, fibs, stuff like that. Price accelerates away, hits anything, any Fibonacci area, it's more likely to close the gap. It behaves like a vacuum, sucking price right back to those large triggers. Any short trades you take in this area tend to get run over quickly. This is what we call the gap theory. And if you go through your spreadsheet with all those pictures, whoops, and I think I have it under the termination conditions, you're going to see that gap theory picture. There's probably 40 of them in there. And that is not a gap theory, and I don't know why that was in there. So that's the only time the midband is going to behave as a termination condition, is when those large triggers remain a full bar away. So I'll bring up that picture. There will be times when your path isn't clear because the areas are stacked. There will be times when you are frustrated because you can't seem to get a clear path. There will be times when you're going to be upset because the darn market isn't letting you get your rules met. And guys, this is 90% of your day. 90% of your day is doing nothing. 90% of your day is sitting on your hands, waiting for advantages. But the cool thing is it's okay to do nothing. It's all right to not be in the market, and it's even probably more okay to not be in the wrong trades. Avoidable losses are the most common losses among traders. The trades that you take when you hope it goes, when you wish that it would go, when you want it to go, not when your indicators tell you that it's most likely to go. So the futures markets, the psychic number 2,900 gold, 70 crude. Gary, I don't know what that means. I've only got one psychic that I trust. I've only got one psychic, one oracle that I will go to, and it's my magic 8 ball. Should I trade into terms? Don't count on it. That's it. That's the only one I go to. Can you show me a picture, Gary? Are you telling me that gold is trading at 2,900 right now? And you're wondering, okay. And 70 is it for crude? I would love to see one of your charts with your rules written on it. That would be awesome. Because 70 in crude is all the way up here. And I would hate to do nothing waiting for that to break when there's opportunities to go long or short. And again, guys, you're going to come to me with your own rules sometimes. You're going to come to me with your own plans. I don't understand what that means, the psychic number. I typically don't believe in psychics. I believe in patterns. I believe in advantages. But I would love to see pictures of what you're talking about because I really do enjoy learning. And I love learning what you guys look for. But just from a typed comment in the room, I'm having trouble getting on board with seeing what it is that you see there. I hope that doesn't sound dismissive because it wasn't intended to be. Guys, 90% of your day is doing nothing. The futures markets trade billions every day. I mean billions. Actually, trillions is what they say. Let's open up gold and see what happens. So you don't have to be in every move. Your job is to be in the best moves, the highest probability moves. And guys, it only takes $400 a day out of that trillions that's traded every day to put you in a 6-figure income. So we've let the large chart do its thing. The large chart should have strong triggers, giving you the advantage of momentum. The large chart should have no termination conditions in the way. Cav, right-click and reload historical data. Different Gary, Ron. That's a different Gary. Cav, right-click, reload historical data. Sometimes it just means that you've got a little data glitch in there. Reload it and it typically corrects itself. So guys, when the large crowd is pushing up, when the large crowd has nothing in the way, we're going to go look for that small crowd to fight. You're going to pinpoint where their failure is most evident. And we're going to do that on the small chart, remember. So your entry is going to be pretty precise, so much so that you can use a limit order to wait for the market to come to you. And you're going to use that limit order at an area. You're going to buy or sell that pullback, that little fight from the small crowd. And it's going to be at an area. Fibs, mid-bands, or yellow 1-to-1s. And you want those areas to be inside of triggers, guys. So this is where I believe language becomes impactful. I'm going to buy or sell a pullback, which means I have to be patient. And I'm going to do it in an area, which means that it's very specific. And I want those areas to be inside of triggers. And that's where the advantage comes in. Because the same way mid-bands are termination conditions if the large triggers are away, guys, price returns to large triggers. It's just a fact of life. If I open up, there we go. I opened up gold, Gary. I'm hoping you show me a picture of what you're talking about. But here's a gold chart, and we'll just take a look at a gold chart. And you've got a huge area of support at 29.21. I'm not sure how 2,900 fits into that. It's so far into the distance. But if you look at a large chart, you'll notice that price pulls away from the large triggers and comes back, and it pulls away and comes back, and it pulls away and comes back. And this happens on every chart, whether it's a large chart or whether it's a small chart. So entries are designed to get you back to areas inside of those triggers, because your large triggers are going to define where the retracement is most likely to occur. It could be the 5-1 large triggers, and it could be the 13-2 large triggers. And you don't know which one it's going to be. So they're both on your small chart, and these help define where the retracement is most likely to occur, where that pushback is most likely to go. So getting back to the idea that I'm giving you guys the best of the best in the first hour here, favorable large triggers is your best look. Favorable large triggers means that the large and the synthetic, that the 5-1 and the 13-2 are overlapping on that entry chart. They're one on top of the other, like two snakes riding piggyback. And this gives you the smallest range where the retracement is most likely to occur. And then when you put areas inside, oh my gosh, that's where it's most likely to bounce. And guys, this creates the absolute smallest window of opportunity. And that window of opportunity is the phrase that you'll hear to describe where the market is most likely to continue, to identify where the small crowd is most likely to fail. So when the rules are met on the large chart, I'm going to turn my attention to the small chart. I'm going to find my entry. And I'm going to see a small chart, hopefully with odds favorable momentum up. And hopefully there's large and synthetic. In a perfect world, they're overlapping. I'm going to start to look for those areas, fibs, mid-bands, yellow 1-to-1s. But it's not time to enter yet. I've got to wait for the fight, guys. I'm waiting for the reversal bar. You're waiting for the reversal bar. And once you get a reversal bar, once you get a down bar after all of those up bars, you're going to identify where the retracement is most likely to go. And we know price tends to return to large triggers. You should write that down. Price returns to large triggers. So on your small chart, I have large triggers and synthetic triggers. And it's just 5-1 large, 13-2 large. So from the highest line of the triggers to the lowest line of the triggers, this is where the market is most likely to retrace. Not guaranteed, but most likely. And the tighter they are one on top of each other, the smaller this area becomes, and that helps with accuracy. But guys, reversal bars are not entries. Trigger lines are not entries. My rules say that I'm going to buy or sell a pullback at an area, at a fib, at a mid-band, at a yellow 1-to-1, and then all caps, loud voice, inside of triggers. So that big white box from the top of the triggers to the bottom of the triggers turns into a small little window of opportunity, guys. And this window of opportunity extends from the highest area inside of triggers to the lowest area inside of triggers. And this is showing me, identifying, pinpointing the best of the best on that small chart where the market is most likely to ricochet and continue with the uptrend, where the small crowd is most likely to fail and the large crowd is most likely to take over. Guys, this is the accuracy that rule number 3 provides. And with a little bit of study and trust, you won't hesitate to activate a limit order, to right-click on your chart and set up a buy limit and say, you know what? I've done all I can do. It's up to the small crowd now. But this is where I want to enter this trade. This is where my advantages are the highest. This is where my entry comes from. And if they are capable, guys, if there's enough down movement to hit your limit order, you're in a long position. You literally bought the market when it was coming down on a smaller, faster chart. But you have the advantage of a market that's likely to continue in the direction of the trend from the large chart because of those strong triggers. And you have a market that doesn't have anything in the way to create a bounce because there's no termination conditions on the large chart. And you entered right where the small crowd was most likely to fail, right where the trend was most likely to continue. And rule number 3 gave you that accuracy. And guys, this is your entry. This is all we're focused on for the first week or two with Nexgen, is being able to identify strong triggers, to be able to identify a clear path, and then to go through the process of identifying your entry. And guys, I think that language becomes the most important on the entries, because People remember the little things that they want to remember. So the reversal bar begins the pullback. Sometimes I see people enter on the reversal bar. Not your entry. You have to identify the trigger lines. And sometimes I see people enter on the trigger lines. Not your entry. The trigger lines define where the retracement is most likely to occur. It's those areas, creating that window inside of trigger lines, inside of the retracement zone. From the highest point to the lowest point, the blue shaded box is where the market is most likely to continue, where the small crowd is most likely to fail. Because price is like a tennis ball, and those areas inside of triggers are like a brick wall. And you're looking for that bounce spot. You're going to activate your limit order 2 ticks above and hope they come get you. And because rule number 3 defines where the retracement is most likely to occur, because rule number 3 defines where the market is most likely to bounce, you understand that anything outside of those large triggers on the wrong side of the triggers is not a part of the entry, guys. This is the wrong side of the triggers. This is where rule number 3 is no longer in play, where the advantage is gone. In a downtrend, large chart says down, down fast, nothing in the way, and you're waiting for the small chart to go up, that little tiny insignificant refinement. Reversal bar is not the entry. It gets you looking for where the retracement is most likely to occur. That's the triggers. The large triggers are not the entry. They have you looking for areas within because that's where bounces typically come from. Your job is to identify and then put a limit order 2 ticks below the lowest. Any fib, 1-to-1, mid-band, anything on the wrong side of the triggers, above those triggers, guys, your advantage and your edge is no longer in play. And I'm going to tell you right now that once price gets to the wrong side of these triggers, guys, you don't know if or where it's going to stop. And if you just arbitrarily jumping in, saying things like, well, that fib has to hold, more often than not, you're going to get absolutely annihilated on that one. But here's the cool thing. Through identifying where the market is most likely to continue, you have created an understanding of where the market shouldn't go. And this is why I think it's important to learn why your entry comes from the areas inside. Because the areas inside are where the market's most likely to bounce. The triggers are where price is most likely to retrace. Anything on the wrong side of those triggers is where the market should not go. This is going to be your initial stop placement. 4 to 5 ticks above for a short, 4 to 5 ticks below for a long. And you're going to say to yourself, man, if the market can push through the retracement zone, if the market can push through the areas most likely to create a bounce, do I really want to be in this trade anymore? My advantage is gone. The reason I was going to enter is no longer in play. And guys, you're going to get hit back here every now and then. But it's usually pretty small risk. And it's a normal part of a positive equity curve. Guys, taking losses is a cost of doing business. Your job is to get to the point to where you're taking the correct losses, not the avoidable losses. You're taking the losses when you have momentum, when you have a clear path, when you define the entry. And they just were able to do it. And you'll start to say, in probably a pretty cocky voice, if they want my money, they're going to have to come take it. If they really want my money, they're going to have to get to where they shouldn't go. And guys, this is your pattern of the two together. Strong triggers, everything says up, the market's cranking, the triggers are through, and then we're done with the large chart, and the large chart is all the way up here. And your first instinct is going to be to say, well, I don't have room to get to that termination condition. Guys, that's not a termination condition. That's a target because it hasn't been hit yet. Price hasn't reached it. But here's the magic of what we do. Your entry comes from Fibonacci support inside of triggers, which means that little run turns into a big run. And guys, that's why these entries increase your profit potential. Some common things I see. People jump in right at the top of the move because they just can't wait anymore. All you've done is increased risk and reduced profit. Very often I see people get faked out. The market starts to go up. The fear of missing out kicks in. All you've done is increased risk and reduced profit. You're learning to trust that this is the best of the best. You're learning to believe that your highest chance of success comes from the areas within. And guys, this is the one that reduces risk. This is the one that maximizes profit potential. Very often people say, but Mark, there's a termination condition. Look at those yellow 1-to-1s. I remember that lesson. Termination conditions are defined on the large chart. You have to remember where your rules are met. Mark, the small triggers are red. They changed colors. I don't have momentum. Notice that the momentum never changes on the large chart. You've got to know where your rules are met. Inside of this one bar is all of this price action. Don't get caught up on anything on the small chart except for identifying where the market is most likely to continue. And this is where that idea of circling tails came in. And we'll do this with gold real quick. Odds favorable momentum. The market had the potential to break the area. If I circle that tail on the large chart, I want you to see what it looks like on the small chart. It looks 100% like a pullback to an area of resistance inside of triggers, and then that momentum pushes it down where the market is likely to go with all of that momentum, and that's precisely where the market stopped, where it bounced. Guys, your trade is between that area inside of favorable large triggers and that Fibonacci area that could stop the market, and that is from 21 to 18. That's a $300 move. That's a $300 move in 55 seconds. So you've got to learn these patterns. You've got to be able to recognize them so that you can catch them in the moment when that market is cranking. And guys, that's your high probability trend trade. That's all I talk about every day for the first hour. Are there any questions about it? The goal is that you can see advantages, then turn advantages into trades, guys. So that you look at your large chart, that you identify momentum and path, and this is the core of your education, guys. This is the one that sets you up to see everything else. Once you get strong triggers and clear path, you don't confuse them for weak triggers and termination conditions. Guys, you've got the good stuff. So go back and take pictures of those. It's not hard. It only takes a couple seconds. And that's it, right? But do more than OFM. Do this. Space between small and large. Odds favorable momentum. Rule 1 met. That's it. That's your look, both directions. Down here, instead of ACH, small's inside large. Weak. Anything can happen. Rule 1 not met. Guys, there's 2 pictures right there. Take those. Upload them. Bring them to your spreadsheet, to that first tab, and start filling this thing up, guys. And come back and study these looks a little bit every morning. Because what happens is those are your core. Those are the 2 that are going to set you up to make you understand when it's time to look for an entry, whatever that entry may be. So as you go through that drill, the high probability trend trade checklist sheet that you're going to get has pictures of what it looks like to have the rules met. There should never be any confusion. And then the second tab is a high probability trend trade checklist to get you into the market, to make sure your rules are met, to give you rules to write on a chart. And nobody has ever used this checklist truthfully and done worse than 70%, ever. I don't anticipate any of you to be the first. And then finally is the KISS plan, guys. I give this away every day. One of the traders, he's been with Nexgen, probably 18 years. He told me, I had the pleasure of meeting him out at the motorcycle races in Austin a couple of years ago. And he told me, and you know, you always talk trading when you meet a client. And he said, you know, I spun my wheels for 3 years, Mark. And nobody likes to admit that. I spun my wheels for 3 years because I didn't have a plan, because I wanted to make the money and I wasn't sure how I was making it. So I relied on luck. And he said, once I wrote a plan, once I had it written, defined why I was going to get in and out of the market, He goes, that's when I became a day trader. That's when I started winning more than I was losing. That's when I quit my job. That's when I started golfing every afternoon and building my motorcycle collection. So, guys, this KISS plan is your stepping stone. This KISS plan gives you something to follow until you can write your own plan. And it is designed to optimize your chances of success with the high probability trend trade while you learn to read your indicators. This is a way for you to find success. This is a way for you to be profitable because this plan wins more than it loses. It's been proven while you find your plan. And then through that simulation study, class feedback, continuous practice, you will build your own plan, guys. And I'm here to help you build it. Post in the room. Tell me what you see, why you're doing it. I'll work my ass off to help you find that next trade. I'll give you everything I have. But start simple. There's two things you have to know before you enter a trade when you're not on sim. And I think that's the big disclaimer. Because if you're brand new, I want you to take every trade you see. Better Dad, if you think you see a long trade, take it. And then tell me why on that chart, why you took it. And we'll go through it, right? And we'll fix what needs fixing. Why I will enter is because my rules are met. That's it. Guys, rules are a description of a pattern that has been proven to win more than it loses. That's all your rules are. So if you take a trade that you named the Bob trade or whatever, and it's got 17 different looks when you get into it, you're not following rules. You're creating rules in the moment. So understand, let it describe, make it prove that it wins more than loses, do that work. And what happens is once you believe, once you trust that it is a pattern that wins more than it loses, the way I trust that the high probability trend trade is, guys, what happens is you don't hesitate. You can't wait to get into that trade. You don't let outside influences affect your ability to take that pattern. And your rules will help remove the emotion of trading. And then you have to know why you're going to exit. And this is, I think, for new users, the hardest thing. Because once you begin to see P&L flashing on the screen, you get that little angel devil like we used to see in Tom and Jerry on your shoulder. One of them's telling you to get out so you don't lose. One of them's telling you to stay in forever so you can make all the money. And I'm telling you, it is a gut-wrenching twister, forcing you to make decisions outside of decisions that make sense. Exits are either taken at profit targets or when advantages go away. So if I enter the trade, my exit is that stop outside of the triggers because my advantage is gone. Or if I'm in a trend trade and 3 divergences print, I exit because my advantage is gone. Or if I'm in one of those 50-50 trades and divergence prints, I exit because my advantage is gone. And guys, management should be every bit as mechanical as entries, as a brand new user. So you've defined your entry. You know why you're getting in the market. Let's learn how to manage. Let's learn how to trust management, to follow management, to get away from emotions and keep it very if-then. So the KISS management plan is based on 2 contracts. You get in with 2. One of them is to get you paid quickly. The other is to develop trust. And it's going to focus on understanding stop placement. So we're going to go through this. I always encourage new users, let your management play out. You're on simulator. Let it play out. Follow it religiously. Try to learn how to keep the emotions out of it. And guys, if your entry is 2 ticks below resistance inside of triggers, your initial stop is 4 to 5 ticks beyond the triggers. This is the KISS plan, the Keep It Simple plan. And this is where the market should not go. This is where the advantage is gone. And the great thing is you'll know your risk before the trade is ever entered. You'll know exactly where your stop goes before you ever get in, and you can decide whether or not that $150 a contract is a risk you're willing to take. But if it's not, avoid the temptation. Well, I'm in at 34, I'm willing to give up $50. Well, 39 is at resistance inside of triggers. Well, I'll give it $70 then. Yeah, but $70 a contract is where the retracement may go. Stops where the market should not go. If you're not comfortable with the risk, don't take the trade. Targets are predefined in the KISS plan at $100 and $200. So if they don't get you, if they don't hit your stop, if you get a reversal bar in the direction of your trade, this is your first stop movement. You will redefine where the market should not go. It should not go 2 ticks above that reversal bar because the large crowd has already started back in the direction of momentum and clear path. You now have $30 risk on the trade. You had $150 per contract, now you have $30 per contract as you move that stop behind the reversal bar. Doesn't guarantee a winner. There are 0 guarantees in trading, but it guarantees a much smaller loser if this one doesn't work out. If price reaches your first target, ooh, voice crack, it's automatically removed. 1 contract is removed. Those funds go into your account. Your sweaty palms dry up. The butterflies leave your stomach. And guys, with 1 contract remaining, you're going to move your stop to break even. Break even may not be the best stop, but you will create your own management plan with a little bit of repetition. But now you have 0 risk on this trade. Profits have already been taken. So not only are you a winner, but you're a winner with nothing to lose. And guys, that's done in the KISS plan. The reason we do 2 contracts is because you're learning to trust the idea that the only reason you would ever enter this trade in the first place is because of odds favorable momentum and a clear path, because this is a market more likely to go down to the next fib than it is to just arbitrarily go up from the middle of nowhere. So you're either going to get stopped out break even, or it's going to go to your second target. And your second target is $200 away from your amazing entry, which means that over the course of 4 minutes, you just made $300. You've exited the market. The adrenaline is over. You have been paid. And there's a lot of people when they come to futures trading that say silly things like, well, Mark, $300 isn't enough. And that's a natural reaction. And I'll raise my hand. $300 doesn't feel like enough in a day. Right? Guys, this was 4 minutes out of your day. This was 4 minutes out of an 8-hour trading day. That's 1 trade. Your P&L doesn't know if you made $900 in 1 sitting or if you had all the advantages and made it in 3 separate trades, or if you took 9 $100 trades. It doesn't matter. The idea is to get paid, and to get paid with the highest advantages. $300 a day, if that's the best you do, is a $75,000 a year. Throw in a break even, you're at 6 figures, guys. And that's the goal. Consistent profits. Profits every day. Getting in, getting out, getting paid, waiting for the next one. And you have to believe that the next one is coming. And that'll happen with a little bit of study. So if I go back to that gold large chart, I want you to see something. And I don't typically show gold, but this was an easy winner. We looked at it. We looked at it together. That was 55 seconds, $300 easy. That was a potential winner. That one hit a fib, so it's not there. That one had weak triggers. We chose not to take it. This one was into a termination condition, not there. So guys, over the course of 25 minutes, there was the opportunity twice to get paid, and there was the opportunity to embrace the idea that I don't have to trade into areas, even with odds favorable momentum, because my advantage is gone. There's another one right there. That was at 8:46. There's another couple right here. That was around 8:30. There's one back around 7. So if you catch 4 or 5 beautiful trades, there's one right there. This just happened at 9:58. Momentum, clear path, there's the tail. What does it look like on that small chart? I know I have gold traders in here. Well, and just because I want you to see I'm not making this stuff up, there it is again. And then if we back up, perfect. Guys, over and over this repeats itself. Learn the patterns. I promised you everything you need to be successful. There's the spreadsheet. Track your trades, take your pictures. There's the zip file. Everything you need. Everything I've presented this morning is in that file, all the way down to the PowerPoint. The only thing that you don't have is repetition. The only thing that you don't have is the saddle time, the time doing the work, getting it done, recognizing the patterns, putting the study in, asking the questions, posting your trades in the room, telling me why. Why did I do it? What did I see? What's my question? So guys, that's what the second half of class is going to be. The second half of class, golly, that's pretty, is going to be 100% dedicated to your questions. 100% answering the questions you have. Does everybody see weak triggers and a big ugly push beyond everything? It would be easy to want to go long right at the fib, right? But it's outside of triggers. It's on the wrong side of triggers. I don't have the advantage of momentum. That's how quickly your reads are going to happen. Trying to figure out where we're at here. 3 divergences in the same price range. That's where the market reversed. My goodness. Crude oil. Weakness. There's your reversal. Down it goes. They're directly into a fib. And then the S&P. It's a termination condition, guys. No matter how much you want that path to be clear, it's not. You've got to let it break. And when you let it break, you have a higher advantage. So when I come back after the break, guys, we're going to go through everything. Everything that you guys have posted, we're going to look at. And I'm going to go back to path. I'm going to go back to momentum. I'm going to go back to entry. And I'm going to give you everything in my brain that I can use to help. So I'm going to request one more time before I leave. And then I'm going to do one other thing because that's what I do. I have trouble saying goodbye. Tell me why. Tell me why. If you post in my room, tell me why. If it's a high probability trend trade, tell me why. If it's a counter trend trade, tell me why. If it's a momentum trade, an HVA trade, if it's one of those chili dog trades, tell me why. Get in the habit of writing whys on your charts because that's how you build a plan. That's how you make it repeatable. And then I like to put this in here as we go into the second hour. Guys, the key to everything is the foundation that we just built. Understanding the basics, then each day compounding. Every day getting a little bit better based on those core lessons. So for you new users, I'm going to blanket you with very conservative rules. The recognition of advantages. Give you a solid plan that optimizes your chances of success as you learn to read your indicators. So for new users, not having momentum, trading in determination conditions, areas not inside of trigger lines. Guys, it's all horrible. Don't do it. These blanket rules are there to increase the likelihood of success. Or do it if you want. I don't give trading advice. But I'm telling you, when you experience success, that breeds confidence. And when you're confident, you're more likely to follow your rules. They're not always bad, guys. But until you have the wherewithal, until you have the experience to know when to use exceptions, it's just safer to avoid those things like the plague. The more time you spend with the software, the more you'll see. The doors will begin to open. Remember, this is a marathon, guys. This is not a sprint. Nobody ever became a millionaire in a week in this room. So learn the process that yields the results, and the results seem to follow. Focus on the execution, not the result. Guys, that's where the KISS plan comes in. And if you keep it that basic, if you follow simple rules, and most importantly, if you're okay as a brand new user, not looking for all of the trades, only looking for the best trades, you can find an extraordinary level of success. I've had people qualify in those prop firms in their first 30 days with Nexgen by just sticking to the KISS plan. You have a sick kiddo needs urgent care. Uh-oh. Let's look at it right now. Now, if it's urgent care and you're waiting for your review, it's not that urgent, better dad. Odds favorable, clear path, pull back to support resistance inside of favorable large triggers. Easy money, easy money. I know you took this hypothetically, but that's it. That's perfect. 100%. Strong triggers with nothing in the way. Pull back to resistance inside of triggers. How easy was that to define? And look at that. You get out at trouble and you held it to the next line on the chart. I mean, this is perfect. Golly, that is actually so perfect. You are spot on to the point that I want to take that picture and I want to put it in the spreadsheet for other people to study. Better Dad's perfect high probability trend trade short. It doesn't get any better than that. So Better Dad, that picture needs to go in your trading plan. That's your pattern. And I really don't think you could have done that any better. This is textbook 100% everything that we look for. So 3 days in, there you go. Watch some videos. You got feedback on about 7 charts, and then you just put all that feedback into play for an easy winner. Guys, this is the process. This has been the process for 20 plus years. Better Dad, you did it perfect. I hope your sick kiddo is okay. And guys, I'm going to go take a break. I'll be back in about 4 or 5 minutes. Keep it simple. Keep it simple. We'll watch the S&P. I'll see you in about 3 or 4 minutes, guys. Post them if you got them. Better Dad, have a great afternoon, brother. Thanks, Cav. Sometimes I feel like I deserve a little break. That one had the potential to break, didn't it? The first pullback didn't have divergence. And then once you start getting divergence with that potential, things go south. 3 divergence in the same price range. There's that lesson. So guys, let's go through. I'm going to scroll up to the very top of the room. And I want you to remember, my job is not to be the trade police. My job is not to tell you whether you should or should not be entering the market. My job is to look at your chart, to talk about what I see, and compare it to what you told me you saw, making sure that you're reading your indicators. So again, Andy, my sincere apologies here, but I'm going to beat on you just a little bit. Large. Well, I know it's the large chart, right? That doesn't tell me anything about the trade. Sell. Okay, you sold, but why did you sell? What made you feel like, with odds favorable momentum, the potential to break everything up on the chart, what made you decide that it was time to fight everything and go short? And even more so, what made you decide to hold for over 6 points as the market continued up with momentum and a clear path, and then it decides to go down? And your brain, and guys, this is one of the reasons that I do this. Your brain sees this as a victory. Your brain says, well, I made money. Guys, you will make money less trading against momentum than you will trading with momentum. You'll make money less trading in termination conditions than you will trading from termination conditions. And this was put together by John years ago. Everybody hear me okay? How to commit financial suicide in 1 easy step. Trading against strong triggers. He built this tongue-in-cheek because, guys, this is one of the biggest account drainers, not just Nexgen users, but traders in general. Fighting the trend, forming opinions, and then trading in termination conditions is the second biggest mistake. Nobody can hear me? Can you give me a Y if you can hear me, please? I feel like... Okay, just making sure. So when I see trades like this, I don't know why you did it. And the only annotations that I really got was, man, I could have made more money on this trade. Well, that's easy to say, right? So this is the Nexgen trade. Termination condition holds. Small triggers roll. Odds favorable. That's the momentum style trade. This is the trade right here, right at the second exit, that typically wins more than it loses to ride that wave of momentum down to the next area. So I love it when you guys get paid. Trust me, I love it when you guys get paid. It makes me happy when you guys get paid. But one of the biggest things, and this is one of the phrases that started to resonate with me the more I do this, is if you win and the rules are wrong, you may have a short-term victory but long-term failure. If you win and the rules are wrong, guys, your brain doesn't know that you fought everything. Your brain doesn't know that you took a chance, that you got lucky, so it tries to repeat. It tries to do it over and over, and typically you end up losing more than you win long term. Simulator millionaire, live market failure. So here we go. Jen, the trend is down. There's no doubt about it. Trying to see where your entry is. 345, 345. So Jen, you had odds favorable momentum against you. Synthetics up, large up, smalls up, no divergences. And you said, I hope it goes down from here because the trend is down. I mean, right? And again, not momentum that fights the trend. What is it about price getting below the triggers, right at those synthetics with odds favorable up, that made you decide that the market needed to go down? It's not even momentum. right? That's a good look for a trend trade long. So I always ask when you guys do this, and again, I love that you get paid, but how many times is trading into lines going to work out for you? How many times is trading into lines, fighting triggers, fighting stuff, how often will that work out? That's all you have to do. You need to go find 50 pictures of this and get a basis. And who knows, maybe it's more than it isn't. And I know this isn't your usual. Why I went after it. You fought everything, hoping it would go down. And it did. And the market rewarded you. I hope it works next time. Boredom. Boredom breeds trades that are outside of your plan. And guys, if you post in my room, I know what your plan is. So I like to say, hey, this one doesn't fit, right? Andy, this is your plan. Andy, you trade with momentum. You trade with direction. You trade from areas inside of triggers. This is what you show me every day for consistent money. Which is why when you fight it, I bring it up. Which is why when you guys deviate from the known plan, I talk about it. Great trade, Andy. Great trend trade. Let's see who's next. Miss Jen again. 50-50. Divergence, no trade. That's fair. I like it. I like it. Rules not met, not taking the trade. What a great thing. All right, Bob. Pivot stop out. Reverses the market. Great recognition. Creates odds favorable momentum. So Bob, did you say clear path because the fib went red? I know we talked about it for a second, but is that why you called it a clear path? Yeah. So I like it because you're paying attention, right? But the fib change, guys, the color change is arbitrary. Let the triggers tell you. Let the triggers tell you. Because support. Let's see if we get another example of where that was support long before it broke. Those remained resistance forever, even after it broke. Yeah. So this was 50-50. I love that you're like, you know what? That's not my entry. Let me force the market to give me my entry. I see this so much where it tries to get there and can't, and then they're like, oh, we forgot Bob. And look at that perfect entry. And it's easy to make money, right? That's the one, Bob. This is beautiful on so many levels. Strong top, odds favorable, potential to break right from the area inside of triggers. And man, I love it. You got paid all the way down. Solid trade. Whoops, where'd that go? I'm going to do a little picture collecting today because I think that's one of the ones people should be looking at. So when people come to this spreadsheet and they're like, man, I'm just going to look for the ones labeled 50-50. Bob's awesome 50-50 short. Nailed it. Great patience, great entry, awesome profit taking. Good stuff, Bob. And sometimes I will go through on the verbiage, ladies and gentlemen, so that we can be consistent on the verbiage. All right. Weak bottom, not a pivot stop out. So can we address the difference between divergence and a pivot stop out real quick? So one of the things, and I'm just going to turn this into a lesson for everybody. So what happens, and there's a pivot stop out. So at first, if price goes down and price goes up, this blue line, this divergence doesn't print until about, stop moving market, until about right there. So this is just a pivot with a loss of momentum. When the market, well, I know how to stop that. when the market comes back and reaches the area, now it's a termination condition. And what a pivot stop out is if price trades below the divergence low, then back above. That's your pivot stop out. And what it is, and if we go to it, this is your pivot where the buyers went long. That's where the sellers stopped out all the buyers and took the rest of their profits before they let the buyers take over. Does that make sense, guys? This is your pivot. That's your pivot stop out. The buyers tried to take over. The sellers gave them a false sense of security, and then they rifled down and they took the rest of their profits out right at that key area. And that pivot stop out, that's what sets off the market in the other direction. So it's subtle. It's a subtle difference. Just a pivot, and then you had it nailed up here. There's your pivot stop out. Where the sellers stole their momentum, the buyers tried one more time, they gave them that false sense of security, and then they just railed them to the downside and set you up for the beautiful trade bomb. Good lesson there. Thank you for posting that. All right, Steve Diego. Steve starts with odds favorable. That area had the potential to break. And then he takes the Nexgen momentum trade, which means that the small triggers break through, price snaps back, and the expectation is hopefully momentum carries it up. And then Steve, it retraces just a little bit, but it retraces to areas inside of favorable large triggers when you had momentum and the potential to break. So you keep your stops where the market shouldn't go. And man, you're out like high tick. That's great. Beautiful trade, Steve. Great hold. Great understanding and expectations. Odds favorable. I'm not sure where you entered. You entered on the way down to Fibonacci. There's that momentum trade. Gets through, snaps back, finishes the move. So 2 for 2. Great. Uh-oh, the charts are getting bigger. No momentum. You get in anyway because the small chart has momentum and the large chart has a clear path. So using that short-term momentum to capitalize on a clear path, and mistakenly entered twice. Whoops. So 4 contracts off. Happy little accident, right? And Steve, the only thing I can say is you're taking the momentum. Here you're losing that momentum. Here you completely lost that momentum. But because you were in for double the contracts, you incorporated a little bit of hope on the trade, right? Now you have strong triggers on the second one. Nope. So you let the strong triggers here convince you to hold here. Letting momentum lead the way. There's a reason it's rule number 1. That took me a second. That turned into a word problem on me. No momentum for the first one. Momentum on the small chart. Quick profits. The momentum grows on the large chart. So when he gets in on the small chart, he's willing to forego. He's willing to sit through a little nonsense because that level of momentum typically finds its way to a fib. Great job. That even took me a second to get there. Really nicely done, Steve. Momentum and path, guys. I can't say that enough. Momentum and path. Momentum style trade, quick contracts, and you had enough movement, enough space between your momentum entry and where the market was likely to go. So 3 for 3. That to me, momentum, that's a warm fuzzy builder, guys. It's hard to stop momentum. Steve just gave great examples of it on 4 different charts. Nicely done. All right, Paul. Let's see where we're at. Everything says up. The momentum is dying but not gone. You take the perfect entry at the area inside of triggers. And if I know Paul, he got paid at 100. And then the stop, Paul, I don't think you're in here. Does everybody see? Let me know if it's just me. To put your stop a couple ticks above support inside of triggers, does that make sense? Just exit. If you're going to exit, exit. I just can't think of any reason to give it back right above support, right? Either go really tight. It's an arbitrary number, and arbitrary numbers get hit a lot, guys. It is in the retracement zone on the way back to the area inside of triggers. Have a great day. Nexgen Jen says goodbye, everybody.
Bye, guys.
Would you please say this is a strong bottom? That is a strong bottom. There you go, Roy. Do you want to talk about why? Or do you just need me to settle a bet for you? Price reaches Fibonacci support. The small triggers can't quite break through. The large triggers can't break through. And then it reverses the market. I would call that a strong bottom because that is the recipe for a strong top or bottom. First, it's a termination condition. Price reaches the area. Both lines of the triggers don't get through. When it reverses the market, it's a strong bottom. That's a perfect one. Price reaches Fibonacci support. Triggers don't break. It reverses the market. That's a strong bottom. Price reaches Fibonacci resistance. Triggers don't break. It reverses the market. That's a strong top. And now let's go the other way. Small triggers get through support. Even though it reversed the market, not a strong bottom because both lines of the small triggers got through. The same way this wasn't a strong top because both lines of the small triggers got through. So anytime you're talking about a termination condition or a strong top or bottom, the recipe is 100% consistent. Let me find my picture. I've got so many pictures I lost them. Hold on. So for a strong top or bottom, always use the phrase. There's your picture. First, it's a termination condition. No triggers get through. And then if it reverses the market, it's a strong top. And look at that. It took like 10 bars for it to become a strong top. And it only took about 4 or 5 bars for it to be here. So Roy, 100% perfect. And that's why it was perfect. Because the triggers didn't break. The decision was so impactful that the moving averages couldn't get through the key area, and then it reversed. Does that make sense? And it's close, right? It's close, but both lines didn't get through. So yeah, great job. I'll confirm every picture you put in, or I'll not confirm it depending on whether or not the read is right. But you got it on that one. Good job. Whoop, Better Dad, we saw yours. Yours was perfect. And then, guys, this is called the chili dog. Ron C. was nice enough to create this trade and share it with you guys. His starts with a termination. Strong triggers off the termination. Not quite odds favorable yet, but actually, yeah, when he gets in, it's pretty close. He's got room to get to the fib, and he just takes a little snippet based on momentum. And the magic phrase, base hit. Guys, if you can get into the market and capture $115 and do it 10 times a day, it's $250,000 a year. It's not about getting all the money. It's about getting the easiest money consistently. And that's what this trade does. It respects the termination. It shows the momentum down. And then it just capitalizes on that push. Steve Diego showed a lot of those in the room as well. Using momentum and just enough room to capture on the way down. And speaking of Steve Diego, here's 2 from him. Odds favorable momentum, Price hasn't reached resistance yet. He takes the pullback to support inside of triggers, and he gets paid again, $275. And man, Steve, I'm not doing the math. I'm not keeping up with it. But those pretty close to what I've seen from you so far today. Up over $1,000, and not one of your trades was more than $150 per contract. That's pretty outstanding. That's a man who knows that his job is to get paid. And man, one of the most cleansing phrases is, I don't care what happens next. I just got paid. Great, great trade. Let's see the next one. Termination, odds favorable. You take the 50-50 trade, the potential to break, perfect entry, 2 contracts off at 300. Beautiful. Amazing again. Once you guys can identify momentum and path, that's when doors open. 10:04, 10:04. What's up with your triggers, Cav? Your large chart has 2 sets of synthetics, or 2 sets of large. But it looks like you traded directly into a termination condition from the wrong side of everything, and you pulled it off. So directly into a termination, divergence prints, no areas inside of favorable large triggers, and you say, to hell with it, I hope it goes back down and retests. And it did. Good stuff. Thank goodness that didn't happen on the first push, because that's the more likely outcome. And guys, that's all I'm going to say. It's Cav's trade. He can take it, right? But look at the reaction. And I'm going to say it. You got lucky that they didn't do that reaction first, because they knew where it was. They knew where that number was, and that's why trading into lines, guys. It's fun when you win. It became a rule because you'll lose more often than you don't. Everything says up, back of the price, clears the bar, momentum over here, quick hits, 11 ticks, base hits pay bills. Very nice. Crazy fast market, price clears trouble, everything says down, base hit, 11 ticks again. Over and over and over. One of the coolest things is that some of the most successful traders that I've ever had the pleasure to work with, all their stuff looks the same. Doing better than trading the NASDAQ today? Right on. All their stuff looks the same. All of their entries look the same. All of their exits look the same. You'll notice that consistency shows up in the people that are posting the most winners in here. Boring pays. Boring pays. That's my Achilles heel. I hate to do nothing. I really do. And I'll tell you, when I've done nothing for too long, I take chances. And they never work. You think I'll learn eventually. 3 divergences in the same price range, even with odds favorable momentum. Do you guys see it? There's your trend trade. There's your advantage going away. 3 divergences in the same price range. And look what the market did. How amazing to have that rule in place. Doing nothing is your best talent. I'm working on it. I'd rather take a couple good ones and then go play golf. What do you guys think about that? Price reaches the mid-band, large chart, large triggers are a full bar away, and price closes the gap to the triggers. There's a pattern. NASDAQ is nutso. There it is right there. Why is NASDAQ not for new users? I'm going to go to 1030. I'm still going to 1030, guys. All right. There's 1030. There's 1042. That's an awful lot of movement. That's a 100-point swing. Look how fast that market moves. Jen, it is nutso. Were there opportunities in there? That was a maybe. That was a possibly, I would say. But just looking at the timestamps, that might have been too fast to catch. That was a maybe. Odds favorable, potential to break. So, man, if the reflexes are there. But look how fast that market moves. People love to trade the NASDAQ because they see more experienced traders trading the NASDAQ. Guys, if you don't know your rules like the back of your hand, NASDAQ will eat your lunch. 100%. NASDAQ will ruin your day. All right. Crude oil weakness, pulled it back to support. Wrong side of the triggers, and it blew right through. So let's just do a chart read. Annotate a picture, take some time. Guys, I'm done with the pictures you guys have posted, so let's either get some questions or we'll just do this. Does anybody want to play along? Do I have strong triggers? What do you guys think? All we're doing is we're just annotating. We're going back. We're learning some looks, guys. Bob says no. That's why you're the man. All right. Do I have a clear path? What say you? Ooh, Bob, you say no clear path? Sorry, I'm talking up here. We're talking where the arrow is. Okay. Smalls and large got above resistance. The path is clear up. Remember the... Oh, I see, because I screwed that up because it's already started down. That's my bad. That got confusing. All right. So we're going to say yes. And let me do this. That's the bar we were talking about. And we're talking about right at the top of it. So absolutely clear path. So I have 66% of what I need for a high probability trend trade. So no high probability trend trade. Does that make sense, guys? Does that mean that's the end of it? No. So without momentum, let me show you. So let me go to this picture. If momentum isn't there, my brain should say make sure path and entry are. And we have path, right? We have path. We don't have momentum. So guys, we can let the small chart be the tiebreaker. Tell us, hey, you've got a medium probability scenario. You may have to manage aggressively. So the rules say, wait for the reversal bar, and at the time of the reversal bar, identify your triggers, large and synthetic, and your entry comes from an area inside of those triggers. So what do you guys think? Is there an area inside of triggers for a rules-based entry? So the answer is no. So what I have to say, and we'll change this one. Whoops. With 66% of the good stuff gone, do I want this trade? And my hope is that the answer becomes no. The answer is, well, no, I don't want that trade. Doesn't feel right. I'm giving away too much. And some of you might take it. That's okay. But as a brand new user, if you go through that process every time, do I have momentum? Well, it just went away. Do I have a clear path? Well, I reached one-to-ones. The triggers aren't through. So without momentum and path, why would I even look for an entry? 66% is gone. Do I have momentum? I do. Do I have the potential to break? I do. Hold it. Do I have areas inside of triggers? Sure enough. Could I take a medium probability shot? Potential to break, odds favorable. There's the potential entry. I just have to manage assertively. So when you break it down that simple, what do I see? Is it all there? It's not? Let me put my management hat on. So it's divergence on only the potential to break, and it's not coming from a strong top. If you're trading the KISS plan, you're avoiding because of this divergence. If you like the level of momentum, you might be waiting for a confirmation bar. I can't tell you guys how to trade. All I can do is get you thinking about advantages and then choosing to trade with them or not. That one worked out, didn't it? So momentum, potential to break, entry area, manage assertively. No need to. It went straight to your target. If only it could be that easy, right? Momentum, yes. Clear path, no. Not trading into a line. And look at the violence. Come see the violence inherent in the system. Termination condition 1. And look at that, crude's still going down without momentum and no areas inside of triggers. Does that make sense to everybody, what I just did there? I didn't say take a trade. I didn't say this is your entry. I just said talk through whether or not your rules are met. Talk through 3 simple advantages and then make the decision on whether or not you want the trade. That's what this class does every day. The hardest thing you will ever do is absolutely nothing. Ron, you're going to go to the beach for a walk? I love it. Does it smell like smoke there? When I was in Washington, we had tons of huge wildfires to the point to where it was like San Francisco fog, but it was smoke. And it smelled amazing. You couldn't breathe. But, oh my gosh, it smelled amazing. It was like having a bonfire, which is horrible because, you know, it's a dangerous bonfire. Not at the shore. Well, yeah, because I guess you guys have the wind coming off the ocean, which helps. Man, go enjoy your day. Always great to have you in here. Steve Diego, first your dog got me up at 1:30, then smoke detector malfunction, beeping every 2 minutes. Never happens in the afternoon, does it, Steve? Had to get a ladder out, replace the battery, so up for the duration, running out of steam. Gonna take a nap, I like it. Steve, great trading today. Great trading. Have you guys noticed that smoke detectors never start beeping at 2 in the afternoon? It's always 2 in the morning. That's about as consistent as price returning to the large triggers, I think. Yeah, we had crazy storms this morning, so I don't think I'm going to go play any golf today. Played yesterday. It's amazing how much golf and trading are the same. Smooth is good. Hero stuff rarely works. All right, guys, I'm going to go take a break. Since we don't have any pictures, there's not any questions, and we couldn't seem to find rules met on any charts just yet. So we'll leave you with crude. We'll see what happens. When I come back, the class belongs to you, ladies and gentlemen. Post pictures if you have them. Ask questions if you have them. Yeah, NASDAQ's going nuts, guys. I'll address that when I get back. I'll see you guys in a few minutes. Go stretch your legs a little bit. Sorry about that. I am back. All right, Bob had a corrected chart read for your trade tracking. Weak bottom, odds favorable, not a clear path, 66% trade. I love it. Perfect entry, beautiful exit. Is that helpful, guys? This is one of the things. Sometimes I build things into the trading plan, or not the trading plan, into the way I teach because it makes sense to me. Does having 66% of your advantages make sense because it means you have to manage? And all it does is it puts you on guard as it says, hey, it's not perfect. Let me look for change just in case. I hope that makes sense to you guys. We've got an hour. What would you guys like to talk about? Nexgen Ben's in here. Well, he was. He just left. What would you guys like to talk about? We've got plenty of time, guys. Cool. So I'm going to mute, and I'm going to wait for a question or a chart, and we'll get going. And I'm going to go ahead and shut down the broadcast because it looks like the market's going nutty according to what everybody's saying. So it's going to be a shorter video. It's